Thanks for being here. And in keeping with the theme of exploring innovation in America, we're going to turn to something that affects every household, and that is family finances. I'm Reid Cramer. I direct the asset building program at New America. And our policy work is really animated by the basic insight that having access to a stock of financial resources in addition to income is particularly consequential over the long term. And in the context of rising inequality and diminishing mobility, it makes sense to take a closer look at the factors that determine a family's ability to save and build up resources that they can deploy strategically. When we examine those relationships, we see that the delivery of responsible financial services that are high quality and low cost is really a foundation for financial security. And our next panel is going to explore the wave of innovations that are unfolding in the field at the state and local level and in the context of federal policy, which are really creating new pathways to financial stability. And in some ways, a lot of this work is coming in the wake of innovations that were destabilizing from the financial sector, from the fringe financial sector. We've had unregulated services like payday loans that really proliferated with a business model that succeeded when people were trapped into debt. And we kind of allowed that to combine with other it undermined family balance sheets, and it combined with other kinds of services like subprime mortgages that in many respects helped launch the Great Recession. So the policy response, Dodd-Frank, the financial reform legislation that was passed in 2010, was designed to usher in a new era of oversight. And one of the things it did was it created the new Consumer Financial Protection Bureau, which was designed to be the cop on the beat of the financial services marketplace. And I think it might be one of the more significant innovations of the Obama presidency. So we've got the CFPB, we've got other actors in the field that are really redefining what financial inclusion means. And today we really recognize that there's a basic set of tools, financial management tools that people need to access as a kind of a prerequisite to full and fair participation in the economy. People need a place to manage their money. They need an account. They need to be protected from predatory products. And they also need kind of clear and transparent information as a way to make financial decisions. So there's a role for policy to play in all of this. But there's also opportunities for people working in the field, working in the financial sector, that can create value by meeting needs and also delivering services at scale. And this panel is going to be a chance to explore those innovations. So very pleased that we've enlisted Catherine Rampell to moderate our discussion here with some of the leading lights in the field of financial inclusion that she'll introduce. Catherine is currently a columnist for the Washington Post, producing some great work on an array of topics that affect families and social policy. And we're very pleased to have this kind of discussion. We do this as a matter of course to try to elevate promising ideas and highlight breakthrough work. But I'll also say that we still are a traditional think tank, and we release policy papers as well. So today we have one that's just out that focuses on the role that flexible savings plays in helping people manage their lives and get their house in order. Our view is that a lot of current policy that emphasizes long-term savings objectives, often through the tax code, through the subsidies for contributions to IRAs and 401ks, it's not only regressive and maybe poorly targeted, but it misses an opportunity to help people get started. So we've seen that even small amounts of savings can make a big difference in people's lives. So our goal with the paper and this panel is really to advance a discussion on how to help more people be included in a financial system and add value to the economy by offering these services that can really make a meaningful difference in people's lives. So in that spirit, let me turn it over to Catherine to explore the cutting edge of financial inclusion. Thank you.
Thank you. So thank you everyone for joining me, and especially this esteemed panel, who I will introduce from closest to furthest from me, not politically necessarily, but geographically. So Don Baylor is a senior associate of the Policy Advisory Group at the Urban Institute, and apparently the most important attribute that you should know about him, at least as it starts the bio that was handed to me, is that he is an 8th generation Texan. And he's also a lead member of the Urban Institute's Policy Advisory Group, which is an emerging practice to accelerate the adoption and implementation of evidence-based policymaking at the state and local level. He currently co-leads projects on Cities of Learning, which is a multi-city digital badging initiative, and an assessment of JP Morgan Chase Foundation's philanthropic investments in Detroit. From 2004 to 2014, he worked at the Center for Public Policy Priorities as a lobbyist, policy analyst, and director of Opportunity Texas, a statewide initiative to promote income and financial stability, create pathways to good jobs, and promote savings, the subject of our topic today, or our panel today. Then we have Janosov, who is the COO and president of EARN out on the West Coast. She joined EARN, the nation's leading micro-savings provider, in 2011, and she oversees the organization's product and public policy divisions, as well as its EARN Research Institute. And then last but not least, Jonathan Mintz, who is the founding president and CEO of Cities for Financial Empowerment. And that is a national nonprofit organization that supports municipal efforts to help low-income families and individuals achieve long-term financial stability. Again, right on target for our panel today. He also founded and co-chaired the Cities for Financial Empowerment Coalition, which brings together multiple pioneering municipal governments from around the country to advance innovative financial empowerment initiatives at the state and local level, as well as the national level. From 2006 to 2013, he was the commissioner of the New York City Department of Consumer Affairs under Bloomberg. And he has also worked as an attorney, professor of law, and second grade teacher. So I wanted to start out by talking a little bit about what the scope of the problem is that we're trying to solve when we talk about financial inclusion. And I was wondering if you could walk us through what kind of access to credit and savings low-income people have now and how that affects their daily lives.
Sure. So with earn.org, we really focus on the savings piece of it. And for us, we really feel that that's the first part that you need to get down before you can responsibly and sustainably consume things like credit and insurance products. So if we just look at the savings scope, there's only, savings is sort of an American problem, right? There was a recent study that came out that said 44% of Americans are living on the edge of poverty, and if there's some sort of a financial emergency, 44% of people don't have enough savings to withstand these sort of financial shocks. That's pretty scary. What we find is no surprise that it's even worse among low-income people. So for the populations that we serve, and these are folks that are usually making less than $30,000 a year, 60% of them aren't using savings at all. And we know that they're the most vulnerable, and they're the ones that really need to use it the most. So for EARN, we define financial inclusion not only as sort of access to affordable financial services, but really designing financial services and products in a way that sort of promote good, responsible financial behavior. Because when people can move on to other savings products or financial services, again, they're using these things sustainably, which is good not only for the consumer, but also for the financial institutions that create them.
And Don, could you talk a little bit about access to credit and what the lay of the land looks like right now for low-income people in particular?
Well, sure. I mean, having spent the last 10 years, kind of fighting the good fight in the State House in Austin, payday lending was a huge issue. In many ways, Texas is somewhat of the ground zero for payday lending. Pretty much a completely unregulated market, no limits on how much you can borrow, no limits on how many times they can actually renew or refinance your loan. And essentially no ability to repay. And so in many ways, there was too much kind of bad credit, kind of crowding out the good credit, and kind of given where a lot of low-income folks are, they either don't have access to things like credit cards, right, where they can actually finance an emergency for a short period of time, or they are somewhat locked out of the financial mainstream due to other issues such as credit issues or even immigrant status, right? And so we found that by and large, when we were able to finally get data in 2012, that Texans were paying about $1.2 billion just in fees alone. And there's another product that is kind of the ugly twin of payday lending called auto title lending, in which you basically surrender your auto title to actually get a loan. And we found that and if you don't pay on time, they will come and get your car, right? And so we found that there were about 36,000 vehicles repossessed in a year, which is close to about 100 a day. And so this really kind of forced people to really think about really having $500 in savings as being kind of a good goal, but it also did really kind of give rise to the need for an alternative product because in many ways, this is partly an income issue. Simply, people aren't earning enough to be able to kind of meet their basic needs, so they're always juggling, and not to mention if an emergency comes up. So we as a coalition recognize the need for short-term, low-cost affordable credit, and so we found kind of a model that kind of works through employers that is able to actually provide that through a new platform.
To what extent is financial literacy a barrier in this area? I mean, like if we had more financial literacy courses in K through 12,
Right.
would that in any way contribute to giving people more financial stability along the lines of what we're talking about?
So I think, from a data-driven perspective, I don't think that we know. But certainly one of the big priorities for the director of the Consumer Financial Protection Bureau is K-12 financial education, and we in Texas passed K through 8 financial education that would be actually integrated into the math curriculum. But one of the things that is key about financial education is that it's critical that it is paired with an activity or a product. So we want to marry what is taught in the classroom with the ability for kids and families to be able to open an account for college expenses or other types of savings.
Yes.
I want to be a bit of a heretic. My background is primarily in education, and our work in the Bloomberg administration began with the classic line you see in any blue ribbon report, which says, people need more financial literacy. But our work over the years and the work of our partner mayors across the country has really diverged at the path, I think, in the difference between education and service. And our perspective from a municipal standpoint has always been that when people are in trouble, they don't need information, they need help. And there's a real difference saying to somebody who's drowning in debt, who can't pick up the phone because it's debt collectors calling, who's afraid to open their mail, their accounts are getting seized. It's a real difference to say to them, I will sit down and help you, versus here's some information and good luck. And so our perspective in this work has really not been around education. It has really been around figuring out how to scale up quality financial counseling and turn that into our mission, which is to turn that into a public service. Mm-hmm. And so that's really where I think our perspective veered quickly away from education into finding the right opportunities for people to get quality help, finding the right products, and leveraging the right opportunities to get them into those products. And when it comes to access to credit, we also diverged, which was, and this is the payday lending fight. It's funny, we're in a lucky state in New York where payday lending is illegal, but I was up in Albany constantly during my years in the Bloomberg administration, fighting efforts to undo the usury cap and to allow payday lending. And the argument from the legislators who were championing those awful bills was, well, who else is going to give them credit? And of course it has to be expensive and they're high risk. And our perspective was, well, we've been counseling X thousand people, and I can tell you the reason they're in trouble is not because they don't have access to good credit, it's because they're drowning in debt. And so what they need is not another product. What they need is help getting out of the mess that they're in and the right kind of responsible products to move them forward. So in many ways, I think that we often fall in this field for the false premise that the issue is credit, when in fact, often the issue is debt and predatory lending.
Now, are there certain policies that actually encourage bad behavior or encourage people to have bad habits when it comes to savings and accessing, some of these very high interest kinds of providers of credit?
Yeah, I mean, I think one of the most common ones, especially in California, that we find to be problematic is the asset limit tests. So essentially, if you want to apply for cash assistance or TANF, you can't have savings over a certain amount. And so in California, it's $2,000. What that means, and what we often see, is people who have done a fantastic job of saving for that emergency that they don't know when it's going to happen, they have to spend it down. And that's unfortunate because those are the people that need it absolutely the most. And so that's probably the primary policy that we're currently working on changing and getting rid of.
So Jonathan, you talked a little bit about this pushback that you got from legislators about the usury caps, and how else do you encourage the private sector basically to take a role in providing credit to low-income people if they're not compensated for that risk? Yeah. How do you respond to that question? Is it just subsidies? How do you encourage companies basically to play a bigger role when they have a lot to lose because they're dealing with a population that maybe has unstable income?
Well, that's a tough question. I would say that, first of all, your underlying premise is the right premise, which is you need to work with the market, and you need to make the market work for the right players and to make sure that the population you're trying to help has access to that market. I think that there are, however, several false premises. One is that they are a particularly risky market. That's not necessarily true. That's just a very convenient excuse. And that's true not only in the fringe sector, but also in the mainstream banking sector. There are a lot of, there's the check systems and the other consumer reporting type products that are advising financial institutions that somebody's a little bit too risky to touch, and then pushing them into the fringe and more expensive markets. I think that going after those premises as not necessarily being true, we've had tons of programs across the country where people with very low incomes have been able to reduce debt at significant levels, have been able to build savings, have been faithful to their loan payments and their rent payments, their utility payments. And so I think that part of the way to move the market is not to figure out how to stimulate the fringe to lower their prices, because they don't need to lower their prices. They've got a great, vibrant market. And even in the markets that they're built out of, they're still able to access these clients. I think it's really how do you change the framework by which the mainstream market is looking at people and talk about really assessing what the actual risk is as opposed to the perceived risk with lower income populations.
Something else that I would add,
yes.
just sort of the question around what role can corporations or the private sector can play. So something that EARN is increasingly doing and sort of something that's really positive and exciting to see is that we actually have a lot of employers coming to us and saying, can you actually offer these services as a benefit to our employees? A lot of the folks that we're talking to are major retailers or service employees, and what they see is when their employees have a car emergency, they don't come to work, and that's a huge problem. And so if they can get their employees to manage their finances and have that emergency savings.
What would be an example of a specific kind of program that these employers are providing?
Sure. So what we do is we basically do goal-based savings accounts. And so what we're rolling out is we're working with employers to provide incentives and supports to teach their employees how to save for emergencies and also to plan and save for the longer term, such as retirement or for their child's education in a 529 account. And they actually, want to provide the incentives or the education and actually fund these programs because they find that when their employees are not worried about their finances or about the next emergency, they are more engaged, they are more productive at work, and they show up to work more consistently because they're not handling these fires all the time, and they actually have the safety net to deal with them.
Yeah, I would even add the importance of employers not just having split deposit, but encouraging split deposit into flexible short-term savings. And so if you sign up as a new employee, there's a typical thing where you kind of put your routing number, to get, and I think this is somewhat of the new frontier, right, is how do you enable that plumbing to begin from the very get-go where automatically an employee begins saving with their first paycheck, right?
I would also underscore what Reid said earlier, which is that we're really a stellar panel. No, kidding. When Reid talked about federal policy, and I think that employer-based approach is really important, but it is employer by employer by employer, and that's where I think there are times where you really need to look to federal policy. We had a program that we tried in New York that the Social Innovation Fund in this administration has replicated in other cities called Save USA, where we were incentivizing people to split off part of their EITC refund right in the tax return, and then providing a 50% match if they saved for a year. I think that the tax code has the opportunity to incentivize that kind of short-term savings that gives people the cushion they need. It's not that people with low incomes don't know they need to save. It's not that they don't understand that there's going to be a car bill that could, or a medical bill that could disrupt their ability to continue to work. It's that they need the right incentive, the way the rest of us have incentives in the tax code, in order to make the most of the resources they have, the EITC being a great resource.
So Don, I know that you've worked at the state level and also at looking at federal policies. What is the appropriate best way to tackle some of these questions? Is it more at the state and local level? Is it coming from some, the CFPB or some other federal regulatory body? Is it both together? What's the most efficient vehicle, I guess, for some of these policy
Well, I think
initiatives?
starting with the federal level is obviously the way that we're going to get to scale, right? Because I think, to some degree, there are states and cities where they just don't have organizations necessarily that are reaching lots of low-income folks, right? So being able, obviously, to reach tens of millions of people through the tax code, through some type of just small change, and being able to divert, a portion of your refund into some type of flexible account is really important. I really think, obviously the work that the Department of Labor potentially is doing with regard to retirement savings and being able to open up more opportunities for employers, especially smaller employers, to be able to offer retirement vehicles. And also I think the Consumer Financial Protection Bureau's work around payday lending probably is one of the bigger things that this field is going to probably or has experienced, right? Because we're talking about millions of people who take out these loans every year. And so when the CFPB kind of comes out with a federal floor, which basically says, you have to have ability to repay, all these other protections, it's going to make, I think, a big bottom line difference for a lot of families.
Mm-hmm. Now, what's the role of technology or technological innovation in tackling some of these questions? I mean, are there things we can do now? Are there ways we can reach people now that we couldn't reach them before that address some of these issues? Yeah,
definitely. I mean, I would say, especially being in San Francisco, we see this a lot, where everybody thinks an app is going to solve the world's problems. But to some extent, that can be true. And where we've seen technology play a really important role, I'd say a few areas. Number one is the data piece of it. Instead of putting someone through an entire program and waiting to see if an intervention is effective, we can now do a lot of A/B testing, which is something that we see a lot in the private sector. And so then that way, we're only investing in interventions that we know work. The other thing, too, I would say that I would not underestimate is sort of this ability with technology to design more delightful products. When I came in 2011, I remember having a user interview. And this gentleman said to me, "I love Earn, I love what you guys do." And I said, "Did you tell your friends about us?" And he said, "No." And I said, "Why?" And he said, "Because I'm really ashamed. It feels kind of like a program for poor people." And now when I do user interviews, and we've basically moved our entire product online, and the interface is such that you would see it in like Mint.com or anything else. When I interview people now, what they say is, "This is a great product. It feels like something that anybody can use, even someone that makes $500,000 a year." And I think that's really key, is that a lot of times, we see technology as something that will just automate really manual processes, which is great. It saves us money. But at the same time, what we want to do is design products that, again, really delight people, that encourage user adoption, because I think that's the only way that people are going to move the needle and not be ashamed to use it and encourage other people to use it as well.
Could you just explain to the audience briefly what it is this app does?
Sure. So basically what we've done is, kind of going back to your points around, you can provide a lot of information to people, but we wanted to build a platform where we would basically be able to see what people are doing in their bank accounts. So we've built a platform off of Intuit where people link their savings accounts that they're using. So if they're saving for just a basic emergency, we want them to link a savings account. If they're saving for their child's education, they would link a 529 account. And based on what they do, if they're doing something really good, we provide an incentive. If they're not doing something great, we provide intervention. And that way we can really link sort of what we're doing to what they're actually doing in the real world.
And when you say intervention, what do you mean?
Yeah.
Like somebody calls somebody up and nags them
Right,
about their finances?
So
or?
something that we do is, there's sort of a combination that we do between rewards-based behavior. So if you deposit a certain amount, you get a match. If you withdraw money, you lose some of that. So that's a very basic example. But basically, people have an incentive to deposit certain amounts and then keep the money in there over an extended period of time and not use it.
And who does the match?
So this is often privately funded, but increasingly, again, we are looking at employers for funding and creating these types of programs.
We've run into two, I think, really important challenges to technology in the banking access line of work, which is what we've spent a lot of time on. There's 17 million Americans that are operating in the fringe financial stream, mainstream outside of the banks. There are two problems that we've seen with technology. It's interesting, the FDIC unbanked study just came out and talked about the huge number of people who are unbanked that nevertheless not only have cell phones but have smartphones. However, the one problem is there's a tremendous trust factor, not just of banks, but of technology around money. So the idea, not for a product that exists to a current account, as yours does, but the idea of starting a banking relationship or conducting banking transactions, you've got a significant trust issue. The other is there's a huge regulatory issue around know your customer regulations from the Department of Homeland Security, which is requiring that banks look at people in the face in person, essentially, and look at their ID and say, yes, this is that person. For large-scale approaches to trying to bank the unbanked in the way that our municipal partners have tried to do, you can't have card tables full of bank employees and really be talking about scale. And so this know your customer issue has really, I think, interrupted the ability of the financial sector to connect to the unbanked but smartphone-connected population because they can't open those accounts online.
Yeah. And I would also add that if folks have seen the movie Spent, one of the, which is really kind of about folks living kind of on the edges of the financial mainstream or outside of it, one of the big takeaways that we got was that the mainstream financial sector is perfectly designed for people that work 40 hours a week and have stable employment, right? If you don't fall into kind of a, immigrant status or other types of status that can kind of preclude you from getting in. But more and more we see that with the part-time work, with piecework, with folks being consultants and having kind of erratic income fluctuations, that the fees and the other components just don't make it work for people too. So there is somewhat of a structural barrier with regard to how mainstream financial accounts are structured and kind of how the labor market is really rapidly transforming.
Are there any interesting innovations that you've seen that address this issue? I mean, with the whole so-called sharing economy, I know that there's been kind of like an introduction of a lot of new kinds of financial products that are intended to address the needs of people who have independent contracting kind of work or spottier schedules, more regular schedules. And there's been some innovation that I'm aware of, but it's more on the insurance side that I know about rather than the kinds of issues we're addressing.
Certainly you've seen a flight to credit unions, you've seen a flight to prepaid cards, you've seen so you've seen kind of a wide variety of consumer responses to the idea that the mainstream financial sector's kind of approach and restrictions don't necessarily work. And so you just see people kind of voting with their feet, but you do see innovative platforms enabled by technology that really are speaking much more towards the kind of the regular type of labor market that we have at this particular time.
Yeah.
I would also, I recommend you seeing Spent, in part because I'm in it. But there are other reasons to see it. But I would also recommend something I'm not in, which is this incredible U.S. Financial Diaries project, which also really explores, I think, the groundbreaking realization, and I'm embarrassed to say realization, your point, which is that for millions of Americans, it's not a question of let's just be smart about a monthly budget. People are day to day, week to week, looking at erratic income and erratic expenses. And this idea of income smoothing and debt, you're starting to hear rumblings of projects where people might say, well, rather than having to pay this bill every month, maybe these bills should be paid quarterly, so that it might encourage people and facilitate people working things out, smoothing it out over a longer period.
What would be the
of time.
mechanism for changing that, though?
Well, you could imagine a pilot project with a utility
Right.
that says, rather than paying this every month, we'll bill you quarterly. And give you indication. I mean, I'm making up a pilot as we talk, but giving you indications of what your bill is looking like, because in the months where people's income exceed their debts, you want to give them the opportunity to build up for the months where it's the opposite. And I think that utilities are a great example. And I also think that municipalities have a lot of different ways in which they are billing people, and could be creative.
Are there any existing pilot projects that you'd like to talk about that might be worth replicating or might be worth doing more research into?
When it comes to income smoothing, I think.
Well, income smoothing or any other interesting innovations that we haven't addressed.
Well, so I mentioned these one-on-one financial counseling centers, these financial empowerment centers, and these counselors have started to become integrated into different social service arrays, and local governments have started experimenting with leveraging counseling as a way of abating fines and smoothing out payments. So that yes, you're behind on these utility bills, but if you sit down with a counselor, we'll remove the penalty for your late bill. We will work out a payment plan with you because we know you are engaged in sort of a trusted service. I think those are really promising. I think that it's a way to upend the idea, and there was this really upsetting article in the Times just the other day about this cycle of people who are behind on their child support getting hauled into jail, and then they can't make any money, and really trying to disrupt that sort of lose-lose perspective on when people are in trouble. Because when people are in trouble, the truth is it's a leverage point as well as a crisis, and taking advantage of those leverage points. There are lots of those.
Yeah. And I do believe the National League of Cities has started kind of a 4-city pilot around utility payments, et cetera.
Really?
So I'm not sure of the status of that, but I do know that they had begun that.
So I think you're probably the best person to ask this question of, which is how would you assess the role that the progress that the CFPB has made on any of these issues so far? Are they on the right path? Is there more that they could be doing given the authority that's granted to them? How important is it to give them some more teeth, I guess?
Well, I think the fact that the director actually got confirmed by the Senate was like a big deal.
Baby steps?
Yeah, that was. I mean, no, seriously. I mean, that was really no small feat, because there were and continue to be many people on Capitol Hill that would wish that they just did not exist. But I think it's probably safe to say that they are kind of here for the long haul. I think one of the things that's really interesting about the agency that I was not expecting from the beginning, and this is really written into their charter, into their mission, is the fact that they are a 21st century agency. And so I think that they actually take that mission very, very seriously in the way that they approach data, the way that they approach innovation, and also the way that they just kind of approach the importance of technology and other types of mobile payments. And so that's been something that has been somewhat of a kind of a welcome surprise on that front. They are very data-driven. I think that they probably bend over backwards to meet with every single stakeholder group that they possibly can, including folks that may not agree with them. So they do a very good job in terms of getting out into the community, not just talking with community bankers and other financial services entities, but also making sure that they are talking to real people.
They're also flexing their muscle,
Yeah.
and I think, you know, there are some who wish they'd flex it less, and there are some who wish they'd flex it more, faster. Don mentioned earlier they put out a real signal to the industry that payday lending is going to ultimately need to sing to the tune of people's ability to repay a loan, which seems like the lowest bar imaginable,
Yeah,
but is
but
a
it's huge,
huge step forward. There have been very targeted enforcement actions by the department that have sent real signals to financial institutions about what is and isn't going to be tolerated. And I think that, you know, I think that kind of regulation is really important. And I think, and my background is in an enforcement agency as well, I think you need to flex those muscles, and you're never going to make everybody happy doing that. But that's, you know, that's the most powerful
your
tool
job
government
as,
has.
as a regulatory agency, I would argue, is not to make everybody happy, right? It's to work in the public interest.
Absolutely, absolutely.
It seems like, that seems...
That's what protection is all about.
Yeah.
You're protecting them from somebody, so
Yeah.
let's go get those somebodies.
Yeah, but I mean, I think that we know that, I mean, I think that one of the things they are really good about is not falling victim to regulatory capture, which has actually been one of the biggest downfalls of other and existing regulatory agencies, quite honestly, is that you end up, because of your close interactions with the industry that you're regulating, that you end up kind of, in many ways, kind of taking their side. And so I think that they've been really good in terms of understanding the perils of regulatory capture and really preserving their independence as a watchdog agency. I would say one of their missions that is not very clearly known is their role in promoting financial empowerment. The Dodd-Frank Act is a little light on that. They don't really give them a whole bunch of tools to do so, but they do give them some mandates to do so. So I think they are doing kind of as much as they can kind of within their statute, but it would be great.
What are they actually doing on that
So
level?
one of their mandates is to promote tax time savings, right? Unfortunately, they don't really have the ability to be able to provide incentives or real resources, you know, to actually make that happen. But I think that they are working a lot with community tax centers to provide them tools to help move the needle on that. So I think that that's one of the areas where they don't, have as much heft in some ways.
I think they're stepping that game up. I agree.
Yeah.
They've needed to. We have a program where we have this summer 8 cities that are turning their summer youth employment programs into banking access programs. Don't give these young adults checks.
Yeah.
Open up a bank account, while you're paying them. And the CFPB is putting some money into replicating that program to a bunch of cities as well. So I think they are starting to ramp up into increasingly tangible and a little bit of resource-driven efforts.
Okay. So we have about 3.5 minutes left. I wanted to open it up to questions if anybody has any for our panel, our esteemed panel. Don't be shy. No one has any
We'll take questions on cocktails as well.
That's right. That's right.
I drink a Rob Roy.
Okay.
Yes, we've had a long and full day. But what my question is, what your view is of products like LendUp. So I'd love to hear that.
I think it's a move in the right direction. We're very good friends with Sasha, and I think there's more to be done. I think it's a move in the right direction. I mean, basically, their model is such where they do actually look at someone's ability to pay the loan back, and when someone pays it back, they move them towards a more favorable rates, et cetera, and so they are rewarding good behavior, which I think is good. The rates to me are still a little high, but I think given what is out there, it is a move in the right direction.
Do you worry at all about the ability of some of these entrants into the financial lending space to access all sorts of other data about users that could be potentially used against them, like in, buying various other demographic information that may not technically be related to protected classes, but correlates highly with race, your internet search behavior or where you live or whatever else is. I mean, are those kinds of new ways that companies are trying to use data to assess risk? Do they present any issues in terms of discrimination or access to capital?
Yeah, I mean, they do, and it's unclear to what extent they're being used. So I think that's always a risk. I don't have the solution for it. I wish I did.
I mean, my bias is that the more information, the better, because I think the risk has been overinflated, and the pricing has followed overinflated risk. So I think the risk is actually much less than the market price is for.
Yes.
So my question has to do with payday loans that I don't quite understand. But here's my question. If we wiped out payday loans, would the people that use payday loans be better off? In other words, they're staying alive week to week, and a payday loan lets them stay alive, probably with exorbitant interest rates. But I'm just trying to understand, if there were no payday loans, what would the people that use them do?
So I can start. I don't think anyone here is necessarily talking about abolishing or prohibiting payday lending. I think most of what we're talking about is making sure that they actually follow sound lending principles, right? And so, short-term credit, right? For some folks, it's necessary, whether or not it's credit cards or whatever. But I think one of the things about payday lending is that they have departed from most of the sound lending principles. And so that has really been kind of the big kind of policy issue.
I think that's important. The other thing is, and I think this goes to the false premise, people don't get a payday loan because they need help for a minute. And the payday loan gets them over that minute, and aren't they lucky that they had access and they had to pay a little bit extra. People go to payday loans because they're drowning, and the loan just drags them down deeper, but a week or two later. So the problem, I think the programmatic response and the policy response to people who are drowning in debt is not to give them more debt. It's not to give them more expensive debt. It's to invest in financial counseling. It's to incentivize savings so that they can withstand those shocks. Many times in Albany, I heard people say, what are people supposed to do if it's 2 a.m. and they need diapers and they don't, and the answer is not, if only these people had access to a high interest loan. That's just not the answer.
Yes.
We have 1 minute. No, we have actually gone over our time. I apologize.
It's a red light.
Yes, okay.
We're going up in time.
Well, thank you everyone for joining us. Very appreciated, and thank you very much to our panel.